We're at a very important crossroads where the market needs to decide what it's going to do. Set all the narratives aside. The market just needs to decide what it wants to do. And then whichever way it breaks out, trade that trend.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here at the end of the week for another weekly market recap featuring my good friend, the fraternal portfolio manager, Lance Roberts. Lance, how you doing?
The older I get, the more paternal I feel.
Thanks. Although I said fraternal,
Oh,
for two
gotcha.
reasons. One, because I've just spent the week with my brothers. I had a rare week away from the computer. It's been wonderful. We
Nice.
get to end today's video actually a little bit early because I've got to take one of them to the airport. But also, Lance, because I think of you as a brother.
I appreciate that. Same,
Yeah,
same goes for me.
thanks. But I don't like my brothers, so
It's okay. I don't like
you
mine.
can understand why. Yeah.
I haven't spoken to my real brother in 25 years, so there you go.
Yeah. Well, there's probably a story there we'll get into at some point.
No, that story doesn't need to be told.
All right. Um, all right. Well, look, so folks, we're gonna keep today condensed and pretty on track. Um, Looking at the markets, Lance, I've been starting to hear in my mind the Talking Heads song "Road to Nowhere,"
Yep.
where the market's trading kind of as we speak, is where it was trading before Halloween
Yeah.
of last year, and we're just about in March now here in 2026. So it really has gone, pretty much nowhere in the past number of months. Um, so a couple questions for you, Lance. Last week, we talked about how the market could be sort of healing here, or positioning it, consolidating and positioning itself for a run higher. Curious to hear if you still think that way. And what we have seen certainly so far this year is capital rotation out of the hyperscalers and the software companies, into more value plays, right? It's been a growth to value transfer. When we talked last week, you were beginning to say, hey, like especially with some of these software companies, like the baby's getting tossed out with the bathwater, there may be a good opportunity to start building positions in these beaten down companies and wait for capital to then re-rotate back into growth from value. Do you still have those sort of same perspectives, or has anything changed in the past week?
No, nothing's changed. Timing is always going to be the hard part, right? So, trying to get these rotations, exactly perfect are going to be difficult. So if you're going to try to play, areas of the market that are under a lot of pressure, just be careful that you're going to have to maybe sit with them for a while, and it's going to kind of be dead money for a bit until the market actually starts to realize that a lot of these narratives that are out there that are kind of driving this current environment are not valid. And when you start looking and when the market starts looking back for where there's a margin of safety, they're going to start looking for companies that have really good valuations and a good moat and a good margin of safety. And a lot of those companies reside in that tech space right now that have been particularly beaten up.
Okay, so maybe we can, we'll do some of the charts in a bit. Maybe you can show us on the chart kind of where capital is still flowing right now and where it isn't. Um, but let me ask you this, and maybe we should just go to the TA and kind of get that over with today.
Okay.
Um, Technically, I'm doing this from memory here, but we had a break down below a couple of daily moving averages, and we were waiting to see if the markets could recover and bounce above them, or if they were going to start acting as resistance. I don't think we've broken back above them, correct?
No. Well, actually, we did. So this was a really interesting week overall. And I wrote about this in this weekend's newsletter that's coming up. It's called, is the market topping or not? Because there's certainly some indications that this market could be in a topping process. And so we want to certainly be aware of that. But if you look back at this week, we opened the week lower on Monday over these kind of AI concerns issues. And then the market rallied back over the next 3 days, and got up, we came right off the 100-day moving average, tested that support, came right off that support level that we've been doing now really ever since last April, broke above the 50 and the 20-day moving average. So that was actually looking pretty good. And then
Oh,
on Thursday and Friday, we reversed all that. We're back down to the 100-day moving average. So we've not gone anywhere this week. So, from a trading standpoint, it's been a bit frustrating if you're long an S&P index fund or whatever. But there's just been this continued kind of consolidation. And every time we rally back up to these resistance levels, we fail and come back down and test support. Now, the good news is that buyers keep stepping in right at the 100-day moving average. We get down there, buyers step in and start buying the market. So that's okay. We haven't broken. Now, if we break the 100-day moving average, which is this black line, then potentially we've got, kind of reversal down to maybe those November lows potentially, which would be around 65.50-ish, somewhere around there on the S&P. So, a 3 to 4% correction, that's completely normal for the market. Shouldn't be anything to be overly concerned about. But the question is that if we do get that kind of a sell-off, is it going to continue to be in the technology space, which has been under the most pressure, or do we see those stocks start to hold up better from a valuation standpoint, and we start to see these really overvalued stocks in staples, energy, industrials, materials, utilities? Do we see those start to sell off and money rotate back to safety in the other direction? Remember, this whole rotation we saw was that overvalued mega cap space into the value space that you and I talked about last October. We said, hey, watch out for this. This is why we're adding some value stocks to our portfolios. We're looking for this rotation. That rotation has now occurred, and now technology is actually cheaper on a forward valuation basis than staples, industrials, and energy, all three of those sectors. So you're overpaying now for the valuations in those kind of value sectors. They're no longer value anymore. And the growth sector has now become much more of a value sector than it was, 6 months ago.
Okay. I just got to ask you, because we're looking at this chart here. I'm guessing you sort of drew
Parabola.
that parabola there at the top. Yeah. Because you look at that and you think, oh, well, that clearly looks like the market's topping. And I'm sure you were doing that for whatever article you were writing, just asking that question.
Exactly.
Yeah, okay. So folks watching this or looking at this chart shouldn't read too much into that. It's really just sort of think of that as a question mark. What would you need to see, Lance, because it sounds like this could even break down to the November lows, and you wouldn't necessarily say it's a rollover. You might just say it's a shallow correction. What would you need to see to think that it was something bigger to the downside?
We need to take out those November lows. And by the way, those November lows are right about where the 200-day moving average is as well. So, there's certainly some concerning signals that are starting to show up. And let me back up here just a little bit. So the 20 days is about to cross below the 50 days. So that's not a great signal, right? So that's a bit on the bearish side. Certainly warrants some caution. And because of that, because of this kind of action right here, we reduced our exposure in our equity model a little bit this week. Nothing major, just a little bit. But last time we had that occur was back in kind of January 2025. The 20 crossed below the 50, then immediately reversed and went up into March. And then, of course, March was where we had the whole tariff, situation resolve itself. But so these kind of crossovers are important to pay attention to. Now, on the good side, we've got a momentum buy signal in place right now, and relative strength, the market isn't really that overbought. So from a technical basis, we've already this consolidation has kind of worked off a lot of that big overbought condition that we had back in, September, October last year from that huge run up from those April lows. We've worked off a lot of that situation. So, downside risk is becoming less. But again, 3 to 5% corrections are completely normal. And that's kind of what we laid out in that kind of South Park article, at the beginning of this year is like, expect a year of lower returns and more volatility. And so far, that's exactly what we're getting.
Yeah.
We've got a lot of volatility, a lot of rotation within sectors. Like I said, volatility's picked up here a bit. It's been a little bit more challenging. If you're an ETF indexer, it's been a little bit more challenging of a market this year. If you're more of a stock picker, it's been a little bit easier because you just kind of pick stocks in certain areas that are doing well. So from being a stock picker basis this year, it's actually been pretty decent. But if you're just kind of an index investor, it's been a little bit more challenging.
Okay. And we've talked about this when markets become more volatile, the passive strategy that everybody's been using for the past 15 plus years, it doesn't generally doesn't work nearly as well, and it's where an active management approach really tends to do a lot better, and that you can actually do well even if the market goes sideways, right? If you're catching the cycles within the process well.
Right, exactly.
Yeah.
You know,
Okay. No,
you
go
know,
ahead.
and right now the market's just holding up support. This kind of dotted black line right here is just kind of these bottoms that we've been running, and the market just has been. This is more of a consult. The article this weekend is just laying out the kind of the is this a topping process? Here's kind of what the technicals say. Could this just be a bullish process building up for the next like higher? I kind of go through that as well. So it's kind of a bull bear point counterpoint type argument. Because again, we could easily break out. If we get to new highs, this consolidation, we'll look back and go, yeah, it was a great consolidation. Should have been
Right.
buying the crap out of the market because this market's now ready to run. So we're at a very important kind of crossroads where the market needs to decide what it's going to do. Set all the narratives aside. The market just needs to decide what it wants to do, and then whichever way it breaks out, trade that trend.
Okay. And right now, do you have a gut feel or an informed feel, one way or the other? Are you leaning more towards a breakout versus a breakdown, or vice versa?
No, I don't. And that's the challenging part is if I had a gut feel. So we've been running so ever since the April low. Let me bring my chart back up here real quick, and let me just kind of talk you through this. So back here in the April low, on April the 7th, right here, we added a bunch of exposure to our portfolio, and we were underweight exposure in equities. We were about 50%, 52% equities during this decline. So we'd reduced our exposure during that whole tariff rumble. And then then at this bottom in April 7th, we had, if you go back and look, the sentiment gauges that we run and the allocation gauges that we run were at the lowest level since the financial crisis. The sentiment was so negative, positioning was so negative. It was just like the buying opportunity, and it was just so we actually overweighted our equities. Our target weight in our 60/40 allocation model, as an example, is 60% equities. We got down to about 52% going into the correction, and then coming out of that correction, we went to 65%. And we ran 65% for most of last year. So we were overweight equities, underweight fixed income and cash. We took that back this week. We're now back to just target weight equities because of this consolidation process. Now, it doesn't mean that I'm concerned about a breakdown now, but I'm starting to position myself that if this market begins to break down, I can more easily get underweight equities sooner than having to come back down through the cycle. So I'm kind of positioning potentially for this to be more of a risk off trade, but I'm not expecting a giant crash, but a 3 to 5% correction back to some of these previous lows would not be surprising at all. That could certainly happen. There's certainly some concerns out there from Iran to tariff policy to AI, et cetera. There's all these kind of things that are out there that are weighing on the markets. So if we get this correction, I don't expect it to be deep because the economic data is still very good. The earnings data is extremely strong. So whatever correction we get is going to be shallow and will be a buying opportunity, but I don't want to ride that down. I want to have some cash available to buy with if we do get a dip. If the market breaks out, then I'll go back to overweight equity and we'll just trade whatever next move as it comes up.
Okay, that makes total sense. So just to be super clear for folks, when you say
Mhm.
target weight equity, that's 60%, right? Because you run a
Right. Well,
60/40 portfolio.
right. So in the 60/40 model, it's 60%, and the 80/20, it's 80, and the 20/80, it's 20, right? So whatever the target weights of the models are, that's where we've gotten back to right now.
Okay. All right. All right. Well, folks, we'll be tracking this week to week from here with Lance, and when he can't be here with his partner Mike Leibowitz. So you'll get a strong sense in real time of where things
Mhm.
are headed. Especially, if we do get a breakout one way or the other, we'll then adjust accordingly.
Sure.
All right. So you mentioned a couple of uh, concerns that the market has right now. The day that we're talking, Friday,
Mhm.
there are kind of two dominant narratives in the headlines. One is that PPI came in
Mhm.
hotter than expected.
Yep.
U.S. producer prices came in at 0.5% month over month versus expectations of 0.3, and higher than the revised number of 0.4 month over month in December. They're up almost 3% for the year. So, a little bit higher than folks expected. This is being driven by services
Right.
mostly, which have been sort of disinflating of late. So this is a bit of a reversal in services. So all of a sudden the market's thinking, oh, okay, maybe inflation is going to be a little bit more of an issue than we thought. The other thing that's going on, which we'll talk more about in a second, is sort of renewed fears of the disruption that AI is going to bring to the corporate landscape. And the company that's got everybody's attention right now is Block, which is run by well, I'm blanking on his name, Lance, but he's the guy who founded Twitter, Jack Dorsey.
Jack Dorsey,
Um,
yeah.
but today, basically, Block announced that it's laying off half of its staff, or approximately half of its staff, because they're saying we just don't need them with AI.
Right.
That the AI models we're running are starting to do the work of salaried people. So
Right.
let's start first with the PPI. I know this is one data point, right now, so don't make too much of it. And I guess my question for you, Lance, is does it in any way alter your thinking that I think you and I have shared up to now that 2026 is more likely to be a year of disinflation than inflation?
So there was nothing really shocking in PPI today. It's not surprising that it ticked up a little bit. If you take a look at all the Fed manufacturing indexes, Chicago PMI, Philly Fed, regional Richmond Fed, Dallas Fed, they've all been upticking lately. So economic growth is coming back, and
Yeah.
we're starting to see a pickup in economic activity. Again, so setting aside GDP, as an example, GDP was 1.4% in the fourth quarter. And as we talked about, that was all due to the government shutdown. So that's going to come back pretty sharply in January and in the next quarter. So when we see first quarter, we're probably going to see a 3% GDP growth in the first quarter, something around there. But because you look underneath the surface, all these manufacturing indexes are coming back rather strongly. This is that reflation trade that we've been talking about here for a while, is that the hyperscalers, they're spending all the money on this Capex to build out these data centers. Well, that's going to translate into economic activity. And so we're starting to see that actually show up now in the data. So it's not surprising that PPI picked up here a little bit. Again, as you noted, it's mostly in services right now. Energy prices have come up a little bit, so that's feeding into it, but energy prices aren't running off to the moon right now by any stretch of the imagination. So, we're starting to see a little bit of a pickup there, but PPI is still running at, like I said, 2.9%-ish. And we run a composite between the CPI and the PPI. So if you take CPI and subtract out PPI, it kind of gives you an understanding of who's absorbing all the cost. And for the last year, the reason we haven't seen any inflation is because all the producers were having to absorb all the cost increases from tariffs, et cetera, and they weren't able to pass that on to consumers. Well, that's been recovering. And right now, that differential between CPI and PPI is about negative 0.8. So it's almost neutral, where it's almost an even balance. They're the consumers and producers are basically just trading off on prices right now. So it's very close to that. So we're starting to see this kind of repair within the system of things kind of going back to more normal levels. And this, we had big divergences coming out of the COVID pandemic, obviously, because we shut down the economy. And that's all starting to normalize. So now we're starting to get kind of more realistic numbers for where we are. But if you kind of look forward, this is, again, like you said, this is one number. And if you take a look at PCE and some of these other data points that really kind of lag inflation data a bit, inflation expectations are declining. The 10-year Treasury yield this morning is trading below 4% on that number. So if the bond market's looking at that number and going, this probably isn't going to be the case for very long. We're probably going to see some more disinflationary pressures later on this year. And so the bond market's already kind of starting to read off on that PPI report. So just from a standpoint of, if you're trying to make a case for inflation to come surging back, you might see a little bit of an uptick because of increased economic activity, but that should be expected.
All right, and Lance, to your point there, the people who care the most about inflation are bondholders, because inflation eats into your real returns.
Right.
And if they were concerned about rising inflation in the future, you would be increasing bond yields to be compensated for that. And as you said, we're kind of seeing the opposite. So right now, at least the bond market's not that worried about this post here. Um,
Well, that's also kind of one of the headlines I saw this morning, is that, PPI comes in hot, stagflation now the major fear. But stagflation, when you look at the definition of it, it's stagnant economic growth, high unemployment, and high inflation. CPI at even 3% is not high. So inflation at 3% is not high. I mean, 7, 9%, that was high inflation last year. But economic growth is not stagnant. I mean, again, we're running pretty strong rates of economic growth last year, with the exception of quarter four because of the shutdown. And if we start to run 3.5% economic growth this year because of all this capex spending, and unemployment's obviously not high right now, right? You take a look at the unemployment data; it's still very low. Um, it's hard to make that stagflation argument at the moment. This is more of an inflation caused by economic activity.
Well, and I think our point here is, you know, uh, it's a blip
Hmm.
so far. It will continue in the future. I don't know. We'll look at it here. But uh, there's a lot of reasons to consider or to believe that the headline CPI inflation measures are going to continue to disinflate for reasons that you just mentioned, and the
Yeah.
bond market seems to be in concurrence with that. Um, I did want to ask you about the PMI, the Chicago PMI numbers, which just came in today. And you've already kind of taken the conversation there already, but let me just share this chart. So you'll see here from this chart, Lance, that for the past 2 months, PMI has really rebounded. So you can see, basically since the middle of the pandemic, we've been in contraction mode here in the manufacturing space by these readings, right? Anything less than 50 is considered contraction, and we've kind of vaulted back up into expansion over the past two readings here. Will this continue? Who knows? But this goes back to the question that I've been asking you for, past several of these weekend chats is, the administration has been saying, hey, look, we've been doing an awful lot, since we got elected to sow the seeds for material economic expansion going forward, and it's starting to kick in here in 2026, and that's why Bessent has been saying, I think 5% GDP growth's in the cards, and Lutnick's been saying, well, I think it could be a lot more than that. Trump
Mhm.
obviously is putting a ridiculously much larger number on that. And so, I've been asking, well, what do you think? I mean, could this be a year where the GDP growth surprises to the upside? I think both you and I are definitely open to that. And you look at that
Sure.
PMI chart, and that's what you would expect to see if what the administration is telling us to expect is actually starting in process here. Now, we'll have to keep tracking it going forward, but I give that as sort of early validation that I don't want to say that the golden age is arriving, but the age of uh, boosted GDP, those are the early signs you would expect if we were indeed entering into that.
No, absolutely. And this is something that I actually had talked about on, I think Friday, maybe Wednesday, on our YouTube channel. But I was showing this chart. So this is CapEx expenditures by hyperscalers. You've all seen this chart before. This is not new. But here's 23, 24, 25, all in the dark blue. And then the light blue is expectations to come. So if you think about this for a moment, what we're seeing occur in the economy, you should have, this was very expected. And, because again, once I start spending money on CapEx, I'm spending that money to go do stuff, right? So we're talking about 500 data centers being built in Texas. North Carolina's building a crap load of them. Idaho's building a bunch of data centers. Well, that's putting people to work. That's buying, materials, cement, building roads, building out electrical plants, et cetera. So all that's feeding into the economy. So we should be seeing that translate into stronger economic growth. So here's two points on this. One, if we do get 4 or 5% economic growth, like Scott Bessent's suggesting, I don't know if we get there or not. There's a lot of other factors that kind of feed into things. We'll talk about the consumer here in a second. CapEx is 15% of GDP, right? So you can do a lot of CapEx, and its impact on GDP is not going to be all that significant because it's only 15%. But the point is, you should see an impact, and we're seeing that again. Chicago PMI, the New York Fed, the Richmond, the Dallas, all those Fed indexes are all turning up. We run a composite between ISM, the manufacturing and services indexes, and the manufacturing side of ISM has been negative for like 2 years. It turned positive this past reading. It's back into expansion territory. Services never got down there. So, we're seeing that translation of that spending into the economy. Now, you're going to get inflation a little bit of inflation, if you have 5% GDP growth, you're going to have 3.5, 3.7% inflation. It's just you can't have that kind of economic growth activity without a pickup in inflation because you're causing demand within the economy. But
Sorry to interrupt, but the
right,
reflation trade basically says, yeah, but it doesn't really matter that much, right? Because if we're growing faster than inflation, and
that's right.
importantly, wages are growing faster than inflation, then consumers are better off net net.
Absolutely. Now that you get the A plus for today's analysis.
Oh, good. Boy,
Now,
you
now
never give me good grades. That's
I know
excellent.
exactly. But now keep that now set that aside for just a second, and then let's talk about the other side of this, the consumer. Consumers, and this is really kind of today's article that I wrote as well.
Yeah.
It's on the website.
Can I make one point before you go there?
Sure.
Because I just
Yes.
want to comment on this chart here. So some people might be looking at this chart and saying, okay, Q1 of 2026 has the highest bar, but then the bars start falling off from there. So
That's right.
maybe the future isn't going to be as big as the past. I just want to point out, this is percent increase. Am I
Right.
correct here?
That is, yes, you're
These are
correct.
the growth rate, right? So the diminishing growth rate as you go into the future is just due to the law of large numbers, right?
That's correct.
And
And
so
but it is notable if I am if my spend rate, right, is slowing down, right, even on a percentage basis, that is going to feed into the economy. So looking at this chart, we should expect that this boom of economic activity we have is not going to be sustainable long term. Because again, let's just step back, forget this chart for a second. Let's just talk logic for a moment. Once I build all the data centers that I need, then what?
yeah,
Right?
totally different point. A good point. But let me just make my point, and then you can
Sure,
finish
sure,
your, which is, so you just pull the chart back up if you can.
sure. Yeah, absolutely.
But so I think like at the end of this year or at the beginning of 2027, it drops down from 86% in Q1 to, yeah, 47%
Mhm.
by Q4. Just remember that 40% is a 40% growth from the total number the quarter before, right? Which is going to
That's
be a
right.
lot bigger than it is right now. So it's still
Oh
an
no, this is not
awful.
quarter before. This is year over year. So not quarter before, year before.
Oh,
So
okay.
if I did 1 million last year, then I'm doing 1,000,005 this year.
Okay. All right. So it's a year over year growth.
Yeah.
Okay. You're right. I see year over year. All right. So then maybe it may diminish. My question here though was for a good while here, for the next couple of quarters,
Mhm.
at least, if not next couple of years, we're still going to be having positive year over year growth. And, look, 47% year over year growth from a
It
large
ain't
number
nothing.
is a lot, right? So all I'm saying
Exactly.
is there's still going to be an awful lot being spent,
Yes.
and that number is going to continue to grow throughout at least this 2 year projection. So don't look at this and thinking like, oh, the spigot's drying up and there's going to be no Capex spending. It's like, no, the growth rate may be slowing, but it's still going to be a ton of spending. So it's going
Yes.
to employ people, all that stuff.
But yeah, but correct. And then but at some point we will have built all we're going to build. Well, we will have built most of it, right? So there's this initial rush to go build all this stuff, but eventually that's going to slow down.
Yeah. And don't worry,
And
we're going to talk about this part when we get to AI and jobs displacement and all
sure,
that
sure,
stuff.
sure. And so once we get all this stuff kind of built initially, yes, we're going to continue to build new data centers, but that spin rate and the speed and the velocity is all going to slow down, and that's going to feed back into economic growth. So a lot of these trades that we're chasing today, as an example, when you're paying historically high valuations for energy stocks, historically high valuations for industrial stocks, you're really depending upon the spend rate for construction to be running almost inevitably into the future. And that's
Yeah.
just not going to be the case. And it's always interesting. Everybody's so concerned about technology. It's like, oh, tech's in a bubble, it's all going to blow up. But you can also make the case that a lot of these other sectors of the markets are starting to get into bubble territory as well from a historical basis. I mean, you're talking about industrials and staples trading at valuations we haven't seen since the dot-com crisis. So, it applies to all areas of the markets. And so the point is just simply to look ahead and say, where does this look like in the future? Which brings us to the consumer, which is 70% of GDP. Savings rates are dropping like a rock right now, 3.5% on consumer savings rates. The credit card kind of spending rate is still going up, but that kind of rate of change is starting to slow down, maybe suggesting consumers are starting to become a little bit more kind of tapped out. And given the weight of the consumer in the economy, to where I know you're going to go to, Adam, if we start having a big reduction in layoffs, et cetera, that's going to certainly impact the ability of the consumer to support the economy. So again, going back to percentages, yes, I'm spending a crap ton of money in Capex. That's 15% of GDP. The consumer is 70%. Who wins that battle?
Right. Right. Okay, good. This is opening the door for where I want to go with this. Just I want to note one thing you said, which is, I'm not saying this is the case, but if everybody was concerned we had a bubble in AI, and now you're saying, hey, we may have a bubble in value. Yeah, the hyperscalers and the growth traders, some of the froth has come off here, but I'm just saying there's the potential that there is a bubble in both. Right? And
Right.
if there are, to the warriors out there, that raises the idea that, hey, if I was worried about the AI bubble, maybe there's an even bigger bubble for me to worry about here. Again, folks,
Right.
I'm not saying that's the case, but it's just
No,
one
no, no.
potential outcome
Just
here.
pay attention to valuations. It's just valuations are important everywhere, not just in tech.
Right, right. And just to echo Lance Roberts, the fact that valuations are stretched is important signal, but it's not a good important. It's not a good timing signal,
Right.
right? This stuff could be elevated for a lot longer than you imagine.
Absolutely.
Let me ask one thing you mentioned earlier too. So you were talking about CPI and PPI and the difference
Mhm.
between the two, and that largely the producers have been eating the impact of the tariffs.
Yeah,
Um, I believe that to be true. I don't have the most recent data on this, but the last data I looked at was that corporate profit margins were still in record territory.
they are.
So, they've had the ability to eat the impact of the tariffs because they've been doing so well relatively. Are we seeing any change in that right now? Like, is there any
Well,
reason to think that the corporations would start trying to push any continued inflation onto the consumer yet, or can they still eat it?
it's kind of a tough question to answer today at this moment. I'll tell you why in just a second. Can you see this chart right here?
Yep. It's a little
Um, so,
small, but yeah.
okay, let me see if I can make it a little bit bigger here. Hold on for me. This is the blue and the red. This is my spreadsheet, so I apologize for the kind of the non-formal view
No,
of
it's
it.
cool. We get to see the sausage being made.
Yeah, if you really want it, here it is. So the black line is earnings. This is reported GAAP earnings year-over-year percentage rate of change, and the blue and the red is the differential. This is the spread between PPI and CPI. So when you'll notice that when earnings are booming the most, that is when it's the favor is tilted towards the consumer. When it's negative, that's when it's not the favor is not tilted towards producers, right? It's a disadvantage for producers. If it's blue, it's a disadvantage to consumers. Consumers are having to eat it. So that makes sense, right? Because if I'm able to pass, if when the consumer is having to eat the inflation, that obviously boosts my earnings and vice versa. So we've been seeing this recovery. You'll see this red line, this red valley here has been recovering ever since 2022. When we got through that 2022 kind of sell-off in the markets, earnings troughed, and then we began having to recover. And slowly but surely, we've started to transfer the price pressure from the producer back to the consumer. The reason I can't answer your profit margin yet is because profit margins are only posted quarterly.
Yep.
So as of right now, this is net profit margins versus the 10-year break-even inflation rates. And and as you can see, just looking at profit margins, they've been stagnant here for a while. But I think once we get this first quarter in, I think we're going to see that uptick to about 18%-ish, somewhere 18, 19%, be somewhere in that range. So I think we're going to see an uptick in profit margins because inflation rates have been, kind of the inflationary pressures have been pretty low. So that's been helping to boost profit margins for companies.
All right. Well, let me just ask this, and it's kind of a naive question, but like, if that's true, if what you think is going to happen is true, and profit margins go back up, how can they justify or otherwise get away with potentially passing additional tariff increases on the consumer when they're making so much profit on a historically comparative basis?
Well, if the world worked in a manner where we all did what was best for everybody else, then this would be a very different world that we lived in.
Hmm.
But the bottom line is simply this, is that if I may, so my bottle of water that I bought from Costco, right? Let's say I sell it for $1 normally, and my input costs come up. But this is a really hot selling item at Costco. I don't know if it is or not. I just
Yeah.
buy this there. Um, but let's say this is a really high demand product at Costco. And Costco says, well, my costs have gone up, so I'm gonna charge $1.25 for this now, and people keep buying it, then they're gonna sell it at $1.25. And if they sell out at $1.25, Costco's gonna go, well, I'll sell it for $1.50. And they're gonna find the point to where consumers rebel and say, I'm not gonna buy that product, I'm gonna go buy a different product that may be cheaper. But that's just business. That's just the way capitalism works. So, there's not a, what drives prices is the supply demand imbalance. And this is the case for everything. Stock prices, grocery prices, egg prices. If you have two, we had with the avian flu, we had chicken prices, egg prices go through the roof because we didn't have enough eggs. And people were willing to pay $8 a dozen for eggs. Now there's a huge supply of eggs, and and consumers are going, yeah, I'm not paying that anymore. So,
Yeah.
the price of eggs have come down. But that's just the way capitalism and
Well,
markets
that's
function. Yeah.
supply and demand in a
Yeah.
free capitalist market. And I'm looking at the time and realizing I got a lot more wood to chop, so I don't want to
Good.
get too distracted on this. But I'm going to say something that might sound a little like, oh my God, that's socialistic. And
Probably.
so you and I have ranted that we don't really have free unfettered capitalism, right? We have corporatism, crony capitalism, whatever you want to call it, right? And we have a lot of industries that are kind of more like run like cartels, right? Where they have a lot of pricing control. They've paid off regulators to get huge regulatory moats and stuff like that, right? So um, the so one could make the argument, hey, they have artificially high profit margins now, and they are sort of scalping the consumer. And of course, the long-term blowback could be not just consumers stop buying their stuff, but they actually complain enough to our elected officials that, they start going after companies for windfall profits or,
Which you definitely do not want to have happen. That's
uncompetitive
that's
practices.
a terrible outcome to do that. The better solution to solve the problem is stop buying iPhones, as an example. Just if y'all would just stop buying iPhones and start going to buy an Android or go buy a flip phone for a year or so, watch how cheap an iPhone will get.
Right, or
The
practice
consumer, the
frugality
consumer,
on lots of things. Yeah, I'm there
yeah, the
with you, and we
consumer
could we
has
could rant about this a lot,
yeah,
but
yeah. I'm just saying the consumer has total control over prices. It's just you've just got to be willing to sacrifice buying whatever fashionable trend item there is on the markets. I mean, there's no difference between an Apple and an Android phone, but you just pay a lot more for an Apple just because you want to buy the brand. There's no different. Look, I think Starbucks coffee sucks, but people buy Starbucks coffee because it's a culture, right? It's a thing. I can buy better coffee at the grocery store, but that's just me. But if we all stopped shopping at Starbucks, the price of Starbucks would come down dramatically.
yeah. So let me earmark this because what I want to dig into here is something happened in recent years where corporate profits went up to a new level,
Yep.
a new high plateau. Something is keeping them there. And
Hmm.
the question I want to dig into is sort of why and, you know, is this healthy? I personally gut feel don't think it is, but I'll be open-minded here. And what can be done about this, right?
Right.
Whether does consumers just have to band together and say, we're going to adopt a culture of tightening our belts a little bit and force these guys to bring things down? Or is there stuff going on? And look,
Sure.
I'm the last guy to say that like the government should be setting prices. And I'm not making that argument at all. But, is there something here? And I wonder if this is sort of where, the administration when it's saying, hey, we got to make sure Main Street gets a turn and whatnot, where there may be some things at times where they say, hey, look, if there isn't problems with tariffs, whatever, you guys are going to have to eat, you guys, the producers, are going to have to eat more of it while your profits margins are above a certain amount. It's interesting.
Yeah.
We don't have time to get into it,
Yeah.
but I
Yeah.
just want to put a pin in it because I think there's something there to really explore.
Sure. Yeah, we can do that. No problem.
Okay. Um, so let me just talk real quickly about Block to get your thoughts on this. So as I mentioned, their stock soared. It was up at least 16% as of this morning on the news that they're basically firing half of their workers here. Um, and Jack Dorsey is saying, hey, like this AI stuff's the real deal. I think you're going to see a lot of companies following our lead. In fact, we think a lot of them are late to realizing exactly how transformative these AI technologies are going to be for corporations. It's about enabling higher ROI in growth and free cash flow. they're saying, and economies at Goldman Sachs have estimated that AI was responsible for job losses amounting to a 5 to 10,000 hit to average monthly job growth to the industries that are most exposed to it in 2025. So they're already looking retroactively and saying, hey, a certain amount of job losses that happened last year were because of this trend, and it's probably going to continue going forward. So my question for you, Lance, is, we've been debating how much of a job killer AI is going to be. I think we both think it's probably going to be pretty substantial material, but we're now starting to really see companies like Block
Mhm.
fully embrace it. I mean, to the point where you're firing half your workforce in one fell swoop. It's kind of nuts
Yep,
to think about it. So, how big of a deal
it's
do
a big
you
deal.
see this? Is this a real signal that we're going to start seeing some real job shedding as we go into 2026?
Yeah, yes, and again, this was a chart that Warren Pies put out last week, showing the differential between AI exposed companies and AI non-exposed companies, and those companies are still adding jobs. Companies that are exposed to AI, those are the ones that are suffering the biggest job losses. So, and that's not surprising. We talked about this before, is that if you have a job that is very systematic. Every day you do the kind of the same job every day, right? You enter data into a computer that,
Right,
or
especially if
or
it's
some
software
sort.
based. Yeah.
Yeah, yeah. You're going to lose your job. There's just no way around it. That job is going to get replaced by AI, and that's just a function of time. Companies, right now though, you AI can't build a data center, right? So we're hiring a lot of construction people. We're hiring a lot of electricians. There's gonna be like 500,000 electricians that need to be hired over the next 3 years,
Right.
that type of stuff. So we're going to see a shift in the job market. And yes, there's going to be AI related employment destruction. And, for people at the bottom of the ladder, they're going to love this because the jobs are going to get cut are going to be a lot of the white collar jobs. It's like, all you rich people finally getting the axe. Well, we're going to see a lot of those jobs because, if you're in sales and marketing and that type of stuff, AI can do that job pretty quick. Look, my job is very exposed to AI. This is why we're developing Simplivisor AI now because it's that future of portfolio management is coming. It's just a function of time, so we need to get ahead of the curve. Um, you know, Honestly, Adam, your job's at risk. How hard would it be to create an artificial AI
Oh,
developed Adam Taggart and have him do interviews, right?
yeah. I don't know me specifically, but probably pretty easy. But there's a lot of competitors in this space already that
Yeah.
are AI generated.
Yeah, exactly. And that's what I'm saying is like, you can look at most jobs and go, yeah, AI can definitely impact that job. Now here's the point. I just did this interview with Forbes yesterday. They read my article on nihilism and they wanted to do a piece on it. And so we had a long discussion on that yesterday. And the reality is that we saw that you'll remember this, right? So back in the 90s, you and I saw a lot of jobs go away because of the internet and .com, right? There used to be receptionists. We don't have receptionists anymore. The fax machine changed a lot of things that were going on. FedEx changed a lot
Sure.
of things. So these
Travel
innovations,
agents, dead.
yes, right. So these innovations, they come along and they do impact the job market, but we also have to look back and go, yeah, but new jobs came out of that. Things that you and I aren't even thinking about today. There's going to be some job that comes out of AI that AI will breed. Again, I have no idea what it could be, but there will be new jobs that will be created, new opportunities. People are going to start, as Elon Musk was talking about. AI is going to allow people to start businesses like crazy, right? So if you've been working for somebody else forever, AI is going to allow you to start your own business very easily in a lot of different areas. So, we're going to see a lot of job creation as well as seeing a lot of kind of traditional jobs are going to go away, but new jobs are going to come along. So we'll see what happens. Now the question's going to be though, here's the question. If the let's just say we lose as many jobs as we make. Let's just say that. But the new jobs pay half as much as the old jobs. That's a problem economically,
Right.
right?
Or
Because
we,
we're 70% consumption driven.
right. And then the other thing too is even with your generous assumption, which my gut doesn't share, but that's
It's
for a
just an
different day.
example. Yeah.
Yeah. But even in your example, we gain as many as we lose. Huge question is okay, if we lose all the jobs today,
Mhm.
how long will it take to get those new jobs? right? Are people out
That's
of
right.
work for a month or are they out of work for 4 years, right?
That's
Like that's
right.
a huge question.
It is a huge question. And then, this is where this is where I think we're making a mistake politically. If I was President Trump, I would be starting to talk about spending money to build out training centers, trade schools, these type of things. Hey, we're going to start an initiative. We need 500,000 electricians. We're going to need plumbers. We're going to need construction workers to build all these data centers to support AI. We're going to fund an initiative to start trade schools. We want to get you out of the inner city into a trade school and into a good paying job. I would be focusing on that and doing those type of things, help people start retraining for an AI driven economy. Look, you're not stopping AI. AI is coming. It's here and it's coming. But we're not doing anything to help people start transition. Everybody's kind of just sitting here waiting to be axed by AI instead of getting ahead of the curve and start getting certifications in AI. One of the differences that's going to be made is, look, software companies aren't going away, but they're going to be adopting AI to a large degree. So on your resume, you better have some type of AI certification somewhere on your resume, because whatever job you're going to go into, they're going to be using AI in some shape, form, or fashion. So get ahead of the curve and start. There's online courses that you can take to get an AI certification. Just do something to get ahead of the curve before your job comes to risk.
Yeah, I saw a chart. I don't have it handy, folks, sorry, but I saw a chart recently and it was the American population divided into these tiny little squares.
Mhm.
And uh, there were three colors. There were people that just aren't using AI at all. There were people who are using a publicly available free AI service. And then there were the people who are actually paying to use the AI service, subscribing to get the better AI and presumably
Yep.
do some higher functioning work with it. And it was just a couple of squares that were in that category, not much more that were using it as a free service. And then, I don't know, 98+% of the rest of the country that's just not engaging with it
Yep.
yet. And basically the point of that whole chart is like, if the tsunami is coming, the vast majority are just totally unprepared for it, right?
Yeah.
So
Absolutely.
again, we don't have a ton of time to dig into this. The key thing I wanted to make is, you and I have ranted about the potential disruption of jobs from AI. I'm a little skeptical about how many jobs it's going to create going forward, especially when combined with robotics. I also am a bit skeptical about what you said earlier is there's going to be a big manufacturing boom in this country, probably for the next 5 to 10 years. But what after that,
Right.
right? And of course, by
Because
that time, the
it's
robots will have learned how to weld themselves too, right?
well, not only that though, but let's say that it takes 5,000 people to build a data center. These data centers are huge. They're like 10
Yep.
football fields, right? So let's say it takes 5,000 people all together to build a data center. But after it's built, you need 200 people to run it,
Right.
right? That's the downstream problem with construction and these type of companies that we're all chasing right now and overpaying for valuations on companies like Caterpillar and Deere and these other companies. I mean, they're great companies, nothing wrong with them, but the valuations are just extreme, and we're assuming that this pickup in revenue is infinite, and it's not.
Right. And again, to that displacement of like, okay, when we don't need most of you anymore. Like I agree with you. I think that AI is going to bring tremendous opportunity for those who, are proactive and entrepreneurial and want to create their own company. And it might be a one-person company that's just run by all the agents that you create, right?
Right?
Um, but being honest, I think that is a relatively small minority of the population that's going to go that way. And it's what happens with everybody else. And the reason why I'm bringing all this up here is just, I think what happened today with Block's announcement, it's a sign that, this not only is it game on, but this pace may be faster than almost everybody, even those that have been following this space, maybe have been predicting. So, if you're
Well,
trying to keep your head in the sand, you might not have a lot more time before you really have to pull your head out and start thinking.
yeah. Now, one thing too, just also remember that we've had a boomer 3, 4 years in the market, right? Things have been very good for
Yep.
corporations over the last 4 years. So we had a lot of over hiring too. So part of and I'm not saying that what Block did today was simply just getting rid of over hiring, but companies tend to, when boom times are really good, we tend to hire kind of over hire or hire a bunch of people that we start kind of duplicating jobs and things like that. So when things start to slow down or you have something like AI come along, the layoffs may seem a lot bigger than they are because they're getting rid of a lot of that
Well, they're
excess
not big, they're
overhead.
not bigger than they are. They're not maybe as bad as we think because
Yeah,
you're kind of
yeah,
getting at the
they're
deadwood, the less
exaggerating. Yeah,
productive stuff, right?
and
But
I'm
it
not.
doesn't mean it's sorry to
Yeah,
interrupt,
yeah,
but like there is, I think there is a lot of
yeah.
underperforming labor out there, or excess labor, and so even if it's just job shedding of the non-essential jobs, like that could be pretty material. I
Yes,
mean,
again.
just to your point about consumer spending, these are people that are losing their income and not necessarily going to get a replacement anytime fast.
Absolutely right. And so I just want to make sure that we all just approach things with a little bit of rationalization and not just to like, oh my God, everybody's just laying off everybody and the world's coming to an end. Look, I agree with you. I think the job losses are going to be large and the responses to those job losses are going to be key. So again, I think the government needs to get involved with, setting up trade schools, those type of things, at least providing some support for those. Companies need to provide training. I think a horrible idea. Elon Musk was talking about the fact we're gonna have to have UBI. I think if you want to destroy the economy, put everybody on UBI because you just
Our
remove
economy and our
purpose.
culture, right?
Well, that's what I mean, because you just remove purpose at that point. If you don't have purpose, then society gets really bad really quick. So, I think that's a horrible way to go. So I hope we make better decisions. We'll see.
We'll see. So the
Yeah.
reason I'm bringing all this up, and we'll move on to closing up here,
Yep.
but is I think the way I'm looking at it, I have a hard time seeing the near term, like the next couple of years, as we increasingly go in this pathway, as the prospects for the employer rising and the prospects for the working class net diminishing.
Yep.
So I think there's going to be new jobs, the data centers and all that stuff, right? Like there's going to be cohorts that are going to find new jobs, and that's all great. But I think that we're probably going to be losing more than we're creating, and the ability to then jump to something else really interesting that pays you as much as you were making or more, I think is going to be a challenge for people. So I just see this unfortunate period where if you're frustrated with the fact that companies already have record profits and all that type of stuff, and the consumer has not been getting their fair shake, I think it's probably going to continue for the foreseeable
Yeah.
future.
And look, this is thoughtful money. And so that's what we're here to talk about, right? So if you're worried about that happening to you,
Take those actions that
don't
you're
wait. Don't wait for it to happen to you. Start saving today. Look at your budget, cut back on your spending, put more into savings, put more into investments, invest prudently. Don't take a lot of risk so that capital, when something happens, is still there for you. But start building that safety net. So if something happens to you, you've got 6 months of an emergency fund or a year's worth of an emergency fund sitting in cash in the bank for you to live on, to get between jobs, to retrain yourself. And don't wait to get retrained later. Start today. Start learning AI. I just ditched ChatGPT and I moved over to Claude. Claude is freaking amazing as to what I am so impressed with Claude and what it does and how it operates. It's made my life so much easier just in the week I've been using it.
It's really interesting. I haven't used it recently. I kind of use Grok just because I'm on X a
Oh,
lot.
10 times better than Grok.
Really? Okay.
No,
All
yeah,
right,
way
well, I'll go
better.
check it out. So I totally agree, and folks, both on the financial side of things, so that if you know bad news happens to you, you've got the best cushioning for it. But also to the future of Lance's point about like start skilling up, start trying and not just as a defensive measure, but to Lance's point, you might find ways to say, wow, like I could really use AI to either make myself even more essential at work, or maybe detach from my employer and go off on my own now that I can do all this stuff that I wouldn't have been able to do before. So there's a lot of opportunity
Or,
there.
or here, learn to use AI to displace the other guy's job that you work with and secure your own.
Yeah.
So
Yeah, they say your job's going to get replaced more likely not by AI, but someone who knows how to use it. Identify the people at your company you don't like and figure
be
out how
that
to
guy.
use AI to
It's
get
like,
rid of
hey,
them.
boss, look what I can do. You don't need Jim anymore.
Exactly. All right. Just want to get your temperature on one quick thing, and then we'll get to your trades and start wrapping up. Um, we are continuing to see concerns mount about the private credit space.
Yes.
And I think this happened by last week. I think we talked about Blue Owl and it freezing redemptions on one of its business development funds. And
Sure.
that kind of, that definitely raised some eyebrows. And again, not in and of itself a sign of crisis, perhaps not even for Blue Owl per se, but certainly makes the investing world a little bit more nervous about how bad some of these private credit loans may have been because we don't have any visibility into this industry.
That's right.
Today, we just got word that a firm called Market Financial Solutions over in Europe and England, I think,
Okay. Yeah.
basically declared bankruptcy. And shares of a number of big banks there, like Barclays, are getting hit because they've got some exposure to that. But basically, this is sort of like another tricolor, another first brand. It's just making people think, you know what, maybe Jamie Dimon was right. You see one cockroach, that probably means there are more.
Sure.
And how I know we don't have a ton of visibility and data here, Lance, but
Mhm.
from your perspective, uh, how worried, if at all, are you of a market moving event happening in the future if indeed we start seeing more and more casualties of private credit here?
Well, so first I'll understand I don't have exposure to private credit. We don't do that as a firm because of specifically a lack of liquidity, transparency, and opportunity, right? So
Right. But you
we
have
don't.
secondary exposure where if there's like it's not going to be a Lehman moment per se of scale, but if the market freaks out because all of a sudden it's
Well,
about, yeah.
that's what I was getting to. So we don't have any private credit exposure directly. So what we pay attention to is how is it affecting spreads in the liquid markets that we are in. So predominantly we're treasury focused. We do have corporates in our bond portfolios. So we're watching those credit spreads very closely, and we've seen those uptick here just a little bit lately. Not anything of major stress right now, so not overly concerned. MFS is certainly a deal, right? It's 2 billion. It's about $2 billion, so it's not nothing. But in the size of the private credit market, it's a very small fish.
Yeah.
So again, whenever we hear about this stuff, we immediately, and look, my nature is too. I immediately go back to the financial crisis and go, "Oh, is this the next subprime crisis?" And we all remember what happened with Lehman Brothers and all that.
Hmm.
I don't think we're there just yet, but I do think you have to pay attention to this. You and I have been talking about this for a long time, is that, the stuff with this buy now, pay later nonsense, this private credit lending, whenever you have so much money chasing so few assets, you're going to get a lot of bad deals.
It
And
always ends poorly.
yeah, and it always ends badly. And so you get these bad deals because these managers have to place these funds. So this is why it's so important as an investor that you understand what you're investing in. Just because somebody comes and pitches you a private credit fund or private equity fund, ask yourself, why am I so lucky to be getting this? If why are they coming? Why is your advisor coming to you with this when Sequoia and these other big hedge funds and VCs will buy this stuff right off the cuff, and they're in this stuff already. So you're at the bottom of the list. So why are you so lucky to get this really outstanding opportunity? And that's where you have to be really careful, because that's how you wind up in these funds that have like an MFS or a tricolor in them, because they're trying to boost returns and they're chasing poor quality deals to get there to capture money. And again, these people are going to walk away fine. They made their money. It's the investors that take the hit.
Yeah. Well, okay, let me ask you this because I think I'm
Sure.
going to ask you this in the future going forward on this.
Uh-huh.
In terms of your worry level of private credit and its a potential to metastasize to just impact the general markets and make your life difficult as a guy who's
Mhm.
managing publicly traded investments,
Yep.
where is it right now? A scale of 1 to 10, 10 being hair on fire.
3.
3. Okay, great. And
Again, it ain't nothing. If you would ask me 4 months ago, I'd say 1, right?
okay, well, and that's why I wanted to get this on record because I think I'm going to ask you this again and we'll see if it goes up or down from
Yeah,
here. Yeah.
yeah. Like I said,
Okay.
it ain't nothing. We're definitely paying attention to it, but there's nothing here to be. If you're in highly liquid markets, treasuries, triple B corporate bonds are better. You don't have to worry right now.
Okay. All right. So trades. I think you mentioned you lightened up your equity
You
exposure a
did.
little bit. Any other
So
specific trades?
yeah, yeah. So we're doing a couple of shifts. So this week we just kind of reduced some exposure very slightly. We didn't sell outright anything to any great degree. We trimmed back on JP Morgan. We trimmed back on BlackRock just a little bit. We trimmed back on Berkshire Hathaway just a little bit, just to bring our overall exposure down to 60% in the portfolio. So again, we're back to target weight. So in our 60/40 model, as an example, we want to be at 60% weight. We were overweight equities for most of last year. So we're just bringing that back to target weights right now. That gives us the next opportunity if this market does start to deteriorate some, that we're going to see, we can easily reduce that exposure. Now, coming up on Monday, we're going to be starting to dig in a little bit, and we're going to be trimming off. So back in October, we added a couple of value companies, Altria, Verizon. Those have had huge runs. So we're going to be selling Altria and Visa and taking those out of the portfolio because we have some concerns on the consumer side. So we're a little bit worried about Visa. So taking Visa out of the portfolio. We've held it for a long time, but we're going to take it out for now. And we're going to add some money. We're going to use that money. We're going to keep our equity weighting the same, but we're going to add to Microsoft and start, buying a starter position, and like ServiceNow and Salesforce, and start
Okay.
kind of digging into some of these really beaten up software stocks because
Okay. Which is
valuations
what
are
we talked
just
about last
compellingly,
week.
yeah, valuations are just so compellingly cheap here.
Okay. And cash flows are still really good and all that
Yeah,
stuff.
yeah.
So,
And again, we're buying starter positions. I hope these stocks can even go lower, and then I can add to them.
yeah, got it. And
So,
so just to be super clear, you are now putting into practice what you flagged for us last week that you would probably do.
yeah,
Yeah.
exactly.
Okay. Awesome.
And we may be right, we may be wrong. We'll see. But that's why we take small positions.
Yeah.
And if we're wrong, it doesn't hurt us. And this is why you don't go buy big positions and stuff right up front. Just wade your way into it. Make sure that your trade's going to be right, and then you can always build on it if it goes up.
Okay. Yeah, that's brilliant. You may be right, you may be wrong. I think you can say that about every single investing decision you make.
Every trade is a binary bet. You're either right or wrong.
I mean, I guess you can be really right or really wrong, but yeah.
Correct.
Okay. Well, all right. Let's start wrapping it up here, Lance. We don't have time to do a full rant. I just want to give a quick nod.
Sure.
And I was certainly obviously teasing at the beginning when I said I hate my brothers or don't like my brothers. So had a great week with them here. It's really been fun. Got to go skiing for the first time in, God, 15 plus years or so. And it's great doing it out here in the West, especially when you grew up skiing in New England, which we did, which is basically learning to ski on ice.
Right.
Out here, it's just
It's actual snow.
the locals kept talking about it had rained the day before, and the locals kept talking about like, oh my God, the conditions are so terrible. And we're like, are you kidding me? Like this is this is like 10 times better than what we've ever had. So, anyways, super fun, and I just want to say that it'd been a long time since I'd taken some time away from the computer, and it was a really good reminder of kind of the why. I'm doing everything that I'm doing in terms of, work focus and all that stuff. And I just want to, emphasize that so that hopefully folks who are watching here will make some time in their life to do something similar and really remind themselves of, okay, if I'm working really hard to invest, or if I'm working really hard to grow my income or whatever, don't forget to take some time along the way to keep your eye on the prize and say, okay, look, why am I doing all this? And also like, let me enjoy a little bit of it along the way, because tomorrow's not guaranteed, right? We don't know if, that bus might have our number on it tomorrow, right? And we want to make sure that if our life flashes before our eyes, we said, okay, I got enough of the living I meant to do out of it all, right? And look, for me, you hear me talk on this channel about, money, it's important, but it's a means, it's not the end. The end, what really defines a rich life is quality relationships, meaning, and good health. And I just spent 3 days basically having a ton of fun, with family and friends. And a lot of it was really physically active, right? And so it was all three things, right? It was finding meaning in my quality relationships, doing things that I could do because I've been investing in my health. Can't recommend it enough for folks. The only thing I'll say at the end here too is my brothers and I, we do this annually. And it's a great time for all the reasons I just mentioned. But one of the things that we have started a tradition of doing is we spend some time kind of talking about, okay, for each one of us, what's a big goal of yours for the year ahead? And, we kind of get each other to kind of articulate it and put it out there. And then over the coming year, we check in and we try to keep each other accountable for, hitting those goals. And, if we're having trouble or is there setbacks or whatever, we can, talk it through with each other. And it's really become something I think has been really sort of like a force accelerator in our lives. So, Again, you don't necessarily have to adopt that with your own family or your own, inner circle, but we found it to be really useful. So anyways, Lance, I'm gonna wrap up here in just a minute because, like I said, I took one brother to the airport before we recorded. I got to take the other one now. But you're actually happy that we're ending a little bit early too, because you, I think, are going out to spend some quality time with one of your children.
Absolutely. Yeah. We're going to, as soon as we hang up here, I'm on the road heading up to Austin to spend the weekend with actually both my daughters. One's at Baylor and one's in Austin. So we're going to split the time up there and spend some days with each of them. So yeah, looking forward to it.
All right, great. Well, so folks, if you watch this channel to become a smarter investor, please take what we're talking about here as your nudge from the universe to invest in the things that truly matter to you. All right. Well, look, in wrapping up here, folks, if you think one of the ways to invest your time in the ways that will truly pay the best dividends for you is to continue to watch Lance Roberts on this channel week in and week out, please let him know that by hitting the like button, then clicking on the subscribe button below, as well as that little bell icon right next to it. If you would like to get some help from a professional financial advisor based on any of the things that Lance and I have talked about here, or if the future unfolds the way that Lance and I have been batting back and forth here, I highly recommend that you get that from a financial advisor who at least takes into account all the macro issues that Lance and I have been talking about here. If you don't have one in your life who's already doing that, or would like to get a second opinion from one who does meet those criteria, then consider talking to one of the firms that Thoughtful Money endorses. These are the firms you see with me on this channel week after week. Maybe you'd like to talk to Lance and his team there at RIA. To do that, just fill out the short form at thoughtfulmoney.com and the firms will be in touch with you right away. Lastly, it just hit me, picking my head up after this week, that we only have 3 weeks left before Thoughtful Money's spring conference. So if you haven't bought your ticket yet, run, do not walk, to buy it at thoughtfulmoney.com/conference because we're still offering the lowest early bird pricing, but that's only going to last for the next week, and then the price goes up. So I want to make sure everybody gets that lowest price. And if you are a premium subscriber to our Substack, look in your email inbox for the code I've sent you. You can use that to get an additional $50 off of that lowest early bird price. It's a phenomenal faculty. Real quick, doing this just off the top of my head again, Lacey Hunt keynoting it like usual with his graduate level series of charts. We'll have first timers Ed Dowd, Michael Oliver, and everybody's really interested to get his forecasts for the precious metals. We're going to have famous journalist Matt Taibbi piping in. We're going to have Judy Shelton. We're going to have Danielle DiMartino Booth. We're going to have Luke Roman. We're going to have Brent Johnson. We're going to have Stephanie Pomboy. We're going to have Grant Williams. We're going to have Rick Rule. We're going to have Melody Wright. We're going to have David Hay. We're going to have Michael Howell. We're going to have Darius Dale. We're going to have Andy Scheckman. There's probably one or two that I'm forgetting, but it is just an unbelievable lineup, and that's all coming at you on Saturday, March 21st. That's when the conference is. And will be, if you can't watch live, don't worry, because everybody who buys a ticket will be sent the replay videos within just a couple hours of the event ending. So it's going to be great. But don't forget, if you haven't bought your ticket yet, go now to thoughtfulmoney.com/conference. All right, Lance, as usual, my friend, I'll give you the last word here.
That's it. Have a great time with your brother, and I'll see you next week.
All right. Thanks so much, buddy. Have a great time with your daughters. Everybody else, thanks so much for watching.
In the next handful of months between now and the end of the year, silver's likely to be in the $60 to $70 price range. And I think the surge will also carry us highly likely to a 2% level, which again is routine. To be unexpected to see silver at 2% the price of gold. And in fact, in bull trends, like 1979, 1980, 2010 and 11, silver got up to 3.5 and higher price of gold. Well, right now, silver's 1.12%. The K in the dollar has been so great that, again, to match the real converted value of silver in 1980 at $50, you'd easily have to be a couple $100, maybe more. And in even 2011, you'd well over 100, I'm sure. So those are really sort of jokes. And our assessment is that, one, I don't know how high silver's going. I think it could go into the hundreds. 100 to 200 would not surprise me.
Central bank and sovereign demand for silver is rising, supporting higher prices, while COMEX and LBMA delivery activity and ETF redemptions indicate big players are taking physical possession. Analysts view silver as undervalued versus gold and expect a breakout, targeting $60 to $70 by year-end, with potential $100 to $200 plus in a full monetary or credit stress scenario. Risks include unverified accumulation data and uncertain timing of delivery squeezes. Michael Oliver, CEO and founder of Momentum Structural Analysis, argues that measuring silver in dollar terms is almost meaningless. He sees silver potentially reaching $100 to $200 but takes it in stages, personally favoring silver miners over gold. Historically, silver has averaged around 2% of gold's price and even hit 3 to 3.5% in past bull markets, while today it sits at just 1.12%. With silver already up 42% this year versus gold's 37%, technical charts suggest an imminent breakout. Several well-known bullion commentators and dealers' voices like Andy, Bill Holter and Mike Maloney argue the market is now driven by huge physical demand, tightening supply and central bank sovereign buying, conditions that can push silver rapidly higher and make a $60 to $70 year-end print plausible. They point to record COMEX delivery interest, growing central bank interest in silver, and China's physical buying as the catalyst for an imminent breakout. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
I think it's really relevant. Yeah, as I said, so many years have passed that the real value of the money unit that we're measuring by, the dollar in this case, or you could do it with euros or anything else, is just meaningless. The decay in the dollar has been so great that, again, to match the real converted value of silver in 1980 at $50, you'd easily have to be a couple $100, maybe more. And in even 2011, you'd well over 100, I'm sure. So those are really sort of jokes. And our assessment is that, one, I don't know how high silver's going. I think it could go into the hundreds, 100 to 200, would not surprise me. But we're taking it in segments. And my own personal investments, which we show at the end of each report, the disclaimer, are heavily in silver miners as opposed to gold. Okay, though gold is the mama, it's going up. Silver has both outperformed and underperformed gold on a routine basis over the decades. And if you go back 50 years and look at what is the highest relationship of silver to gold in any one of those given years, and plot it, we have a graph we put in the latest report. 2%, meaning divide an ounce of silver into gold. Silver was 2% of the value of gold in 20 of those 50 years. So it's not absurdly, to be unexpected to see silver at 2% the price of gold. And in fact, in bull trends, like 1979, 1980, 2010 and 11, silver got up to 3.5 and higher the price of gold. Well, right now, silver's 1.12%. Okay, still dirt cheap. It got under 1% recently, which is historically very, very low level. When you see that, buy it. But when that spread turns up, and it's been turning up sharply, well, just for example, this year, people don't realize this. Silver's up 42% on the year today. Gold's up 37%. And yet most people still think silver's lagging. It's not. It's catching up to gold. And there are certain technical levels not far above where we're trading right now that if silver spread versus gold can reach those levels, the spread chart and the momentum of the spread chart, which is what we look at, both technical metrics, have very clear pending triple top breakouts, meaning levels that they've stopped twice before. And if you punch up through that, these levels go back several years, by the way, you're breaking out big time. So if you looked at these charts, these spread relationship charts, and treated it as a price chart, you'd say, oh boy, you break through that and I'm going to blow the cork off this thing. The spread is about to do that, I think. And when it does, I think in the next handful of months between now and the end of the year, silver's likely to be in the $60 to $70 price range. And I think the surge will also carry us highly likely to a 2% level, which again is routine. Well, that's a huge move because we're talking almost doubling the current relative value of silver to gold very rapidly and going up to that, quote, normal 2% level. because we're, like I said, 1.12% right now. So anyway, I think there's a huge explosive potential in silver, coincident with the rise in gold, but advancing more so. And so that's why my personal emphasis is in the silver aspect of the monetary metals.
Michael Oliver warns that relying too much on fundamentals can mislead investors about timing, like the analysts in The Big Short who were early but not immediately proven right. In 2025, silver has risen 45% so far, hitting about $42 by mid-September. Rising industrial demand for EVs and solar panels, continuous supply shortages of about 800 million ounces since 2021, and growing central bank and investor accumulation through physical holdings and ETFs are the main drivers of its climb. Although supply is static and demand is dominated by China, silver's industrial role is expanding. Nevertheless, until prices compel attention, markets frequently overlook such truths. More significantly, silver has historically been used in conjunction with gold as money. Confidence will crumble as inflation reduces purchasing power and people lose faith in institutions, currencies, and central banks. This transition from optimism to anxiety could be brought on by a declining stock market. Major systemic changes, like the Federal Reserve's demise or income tax reform, are made possible under that setting. That unrest will help silver as an industrial metal and as currency. Let's shift our attention towards the interview.
Well, first off, I don't look at it that much, and I try not to, okay, because I don't want to be distorted by a notion of fundamentals. Why? Because quite often fundamentals, even if they're true, even if your assumptions are correct, that doesn't tell you about the timing. Mm-hmm. You could be right and not be right in terms of price reaction for 2 years, okay? You know, do you remember the movie The Big Short?
Yeah.
The guy, these 3 or 4 analysts around the country, different guys, didn't know each other, all came up with the same conclusion. There's going to be a mortgage crisis. There's no way around it. They pounded the table, okay? That was 2005, 2006. And it wasn't until late 2007 that the stock market finally topped. And it wasn't until 2008 finally that they said, I was right. So you get the point, fundamentals. Mm-hmm. Okay. Silver does have certain unique, we know the industrial aspect. It used to be, you take a picture, that silver was a key factor in photography. Now it's a key component of solar cells. And it's also, as I understand, essential in the big AI explosion because silver is such a good conductor. Okay, well, the numbers that I've seen, and I don't know the validity, they probably are because I see them from too many places, of supply demand on the industrial side is very tight. Annual production of silver is not increasing. It's plateaued and demand is continually increasing. And by the way, China is one of the chief demanders of silver because they're like 80-90% of global solar production, solar panels, which silver is essential. So anyway, that could become a factor where, let's say we cross 50 and CNBC needs an excuse to explain it, okay? And that's a good excuse. Oh, well, the industrial demand. Well, that's true now, but sometimes it takes a while for that reality to finally be used as the excuse. The bigger issue is silver's money, just like gold. A lot of people like to treat it as not monetary metal, but as history shows it has been. In fact, the U.S. has had silver as official money too. So I think the crisis we're facing in global assets, global suffering, economic suffering, not just U.S., is going to be such that you're going to get a lot of things thrown up in the air in doubt, where you doubt the validity of a certain institution to provide what it's supposed to provide, like the central bank. You suddenly realize the value of the stuff in your wallet is decaying so rapidly it's ridiculous. As I said, your grandfather, father, and you, house cost, loaf of bread price when I was a kid, it's 52 card pickup. And I think the stock market will be a big key in that. Why? Because right now, if you look at, let's say, the average guy who's got a retirement account, maybe it's through state government pension fund or whatever, if he looks at it nominally and it's been going up, because if it reflects the S&P, then it's been going up. Okay. Not a lot, by the way, over the last year, but, single-digit percent still. It's the only thing he's got to smile at. Everything else in his life is questionable. Cost of things are going up. et cetera, et cetera. And when that goes down, then it's, oh, hell, what's good? All you need then is some layoffs, et cetera, et cetera. And suddenly the average guy, instead of a sense of expectation, is a sense of doubt. And that creates fear. And when you create fear, the tone of markets change. And that's when institutions can get overthrown, ousted, abolished. And so it wouldn't surprise me that in a year or two there's no Federal Reserve. If the economy gets bad enough, which I suspect it will, there may not be any income tax, simply because it doesn't function. They go to a sales tax, etc. All kinds of things can change in big ways. I think that's the kind of situation we're facing now.
As trust in fiat currencies and institutions declines, there is a chance for sharp movements. How much higher may silver's price realistically rise in the upcoming years if it even recovers to 2 to 3% of gold's value? Will a decline in trust in central banks hasten the adoption of silver as a monetary asset and an industrial necessity? If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.
Japanese yen is one of the worst performing currencies versus gold, which in my book is inflation. I mean, not that gold isn't breaking out already, but I think silver will accelerate. And like Phil said, for people who haven't bought gold, I guess silver will be the alternative.
For a person, yes, you always want to go seek out as much gold as possible. When a system has a lot of gold revolving around it, you only get two things. You get more jewelry and you get higher prices. So if China reveals they have 30,000 tons of gold, like that, like we think they might, then that means prices in China in gold terms are going to be sky high, and prices everywhere else are going to drop like a rock.
25th of September, the consultation period over whether silver should be a strategic mineral in the United States will finish. They'll have to start building a silver stockpile. And we don't know how big that stockpile will be. Obviously, in the past, it was 2.1 billion ton. If there's a disruption in the supply from Mexico, which is where they're getting most of their silver from.
One of the worst currencies in relation to gold has been the Japanese yen, underscoring the growing pressures of inflation. Silver is predicted to rise quickly as a substitute for gold for those who missed it, even if gold is already starting to break out. By September 25th, the United States must decide whether to designate silver as a strategic resource. The government would have to accumulate 2.1 billion ounces, which is almost 3 years' worth of mine supplies, if it were authorized. Since Mexico supplies a large portion of America's silver, any disruption there might have a significant effect on the U.S. sector. Experts estimate that there is a 4% chance of such a situation. Mario Ineco, a famous market strategist, and Phil Lowe, a sharp macroeconomic commentator, both highlight that since April, the Dow-to-gold ratio has fallen precipitously, and it currently exhibits trends reminiscent of those seen in 2007 before the financial catastrophe. Long-term charts indicate otherwise, despite some people's concerns that a liquidity event may put pressure on gold and miners. It's evident that the trend is strong because banks like Goldman Sachs are now predicting that gold will reach $4,000 by mid-2026. While silver targets are already almost reached. The wider breakthrough indicates that gold's bull market is well established, even in the face of possible short-term pullbacks. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update. We value your thoughts, so drop a comment below and give us a thumbs up if you enjoyed the content.
This one here is the Dow-gold ratio, and we dropped quite a bit in April when we had that beginning of April, and then it's being consolidated, and now it's breaking down, and it looks a little similar to this, and this was in 2007 before the great financial crisis, but I mean, we'll have to see anyway.
One thing I may add, because we were just discussing Weimar, I do want to stress that Weimar was a very unique situation because the Entente powers were not letting Germany default. They said, you cannot default. You have to give us gold. and that's what stretched Weimar out to 2 years. I want to reassure the viewers, like, I think this will be over in 3 to 6 months once it really gets going. It's going to be brutal. It'll be as brutal as Weimar, but it'll be a lot shorter.
Yeah, but in Weimar, it started taking off. The hyperinflation really picked up in the summer of 1922, and by the 1923 it was over. So it was about 18 months. And
I think this will be about 3 months. I think they'll once they start losing control of food prices, I think they'll revalue to gold.
And I thought commodities were going to start a bull market in the early 2020s, only because bonds, I thought were going to start a bear market, and I thought hard assets will benefit in relative terms. But we see now that banks like Goldman Sachs, who usually just push paper and derivatives, they're actually telling their clients to diversify into commodities. And they even, I think they said that they expect gold well above 4,000 by mid 2026 if the Fed's independence is damaged. So I thought that was interesting.
Yeah, I see that. Well above 4,000 by mid 2026 in the middle of your page, Mario. I see that.
Yeah, it's here. Yeah, right there.
Their calls just follow the market.
Yeah. The other couple of weeks ago, Bank of America, which is another bullion bank, they said, "Oh, we're bullish silver. We see silver at $42 by the end of 2026." And I thought, that's not bullish. We're almost at 42 now. So, the bullion banks, I mean, I've been following them since I started following gold in 2002. And now they can't do it anymore because gold is in a massive bull market. But for example, a few years ago, if gold was like 1,500, they'd say, "Oh, in the next few years, we expect gold to revert back to 1,000," and like so on and so forth. But now, they're saying they're bullish, but I think they're not bullish enough. And one of the reasons is these couple of charts here, and I'm going to bring them up. First one is a bit more short term. And this line here, we're going to see in the longer term chart. I think it's really important. And it was around 2,700, this line. And that's why I think we saw this pullback, in the retest. And now as well, I mean, we've broken out of this pennant or symmetrical triangle, and it's really taken off, and there's nothing like above here. So that's very bullish. I'm not saying we won't see any corrections, and then this one is the same chart, but really long term. And this is why that 2,700, in my opinion, was so important. And I was waiting for that test.
Wait, Mario, can you flip back to the other one so I can see the difference for a second? Okay, yeah, and then go to the forward. Okay.
So this is from the high in 1980 to the high in 2011. That's where that 2,700, when we're breaking out here, I thought we might see resistance at 2,700. I mean, we didn't initially because it went up quite a bit, and then I'm not sure, it went 2,900 or something, and then it broke back down. I think it was after the Trump won the election. But now, I mean, we're really taking off, and a lot of people don't look at these long-term charts, and this is why I think people are concerned about a liquidity event.
Rafi Farber, known as the Endgame Investor, in an interview with Phil Lowe, Mario Ineco, and Clive Thompson, points out that China is injecting funds into its banking system through what it calls reverse repos, essentially providing liquidity much like Western repos. The government is trying to reflate its struggling economy, which faces weak exports to the US and a collapsing property market where apartments, once the main savings vehicle, are now oversupplied and losing value. This has left many Chinese households cautious about spending. While some argue China could rise as a global power, others believe its fate is tied to the West. If US consumers are broke, Chinese producers suffer too. On top of this, China holds vast US dollar reserves that may lose value, and even its large gold stockpile could backfire by pushing domestic prices higher and undermining exports. In short, both China and the West are trapped in the same fragile global system, and neither has outsmarted the other. Let's revert back to the...
This is the case. I think when China refers to reverse repo, they mean what we would mean by repo. I think they just got their terms.
Yeah, they are buying. I think they're buying the government bonds from the banking system and injecting cash into the banks. I
Yeah,
think
so
US
that's
is
what
the other way
we would
around,
call
isn't it?
repo. In
Yeah,
China, they
yeah,
call it reverse repo.
yeah,
Whatever. It means they're injecting cash into the banking
yeah,
system. I
yeah.
didn't hear about this. China is they're like on a different wavelength because their interest rates are going down and down and down, and the West interest rates are going up and up and up. I still think that when the West falls, China falls with it because they are the producers and we are the consumers. So if the consumers fall, the producers fall too. Like if you lose your customers, you lose your income. Or if the currency collapses in which you're getting your income, then you lose your income also. Why China would be injecting cash now? I mean, we know. I mean, the place is very opaque. It's still communist, except for the special economic zones that they allow freedom in, so they can supply the West with a bunch of stuff, so they can stack more dollars. But China's economy has been so fake for so long, and they still have these ghost towns and this whole real estate bubble throughout the whole country, and it's still like a very corrupt, disgusting regime. I mean, we're not allowed. We don't really say that because the West gets most of its stuff from China, but that's still the reality, and it's gonna have to go.
Not very different though from our regimes.
That's true. No, I guess in the way it functions, no, but at least I mean the West still has an idea of individual liberty, whereas I don't think the Chinese see that as a value at all, other than maybe a temporary expedient. There's still a feeling in the West that individual liberty is a good thing in and of itself. In China, that was never there.
Things, the Chinese injection of funds, or
I mean, they want to reflate the economy. The China's suffering obviously from the slowdown in sales to America on the one hand, and secondly, the way of saving traditionally in China has been by buying apartments. So many Chinese people bought apartments, and now suddenly they're finding that the bottom's fallen out of the market because there's far more apartments or houses, if you like, than there are people to occupy it, and the population is not rising anymore. So and a lot of building companies have left these blocks of apartments which they're building and that people have paid for. They're half empty. So suddenly everybody is now drawing in their horns saying, oh my God, my traditional form of saving isn't working, and they're not willing to spend money on things. And so the Chinese government definitely has to reflate the economy. I think we're going to see more of that. I think that's just a first step, and we'll probably see more money thrown at the economy sooner or later.
Oh, yeah, there's a lot of people who think that China is somehow eating our lunch, that they've somehow outsmarted us, that and I think your friend King Kong, Eric Young, is talking about the rest of the century is going to be the Chinese century, where China's going to move to the forefront.
yeah,
I don't
think
think
Jim
that's true
Rogers
at
said
all.
that too, didn't he? Jim Rogers, I think, yeah.
Yeah, I don't think that's true at all. I think we're going to see. I mean, we're all going to go down together. It's not like it's not like we're going to do fine and they're going to collapse. They are holding enormous amounts of American dollars. We took all their stuff and we gave them dollars, which we're going to default on, and so all the people holding dollars are going to be completely broke over there. Not to mention they have overbuilt their industry, and maybe some people say, well, it's better to be overbuilt than underbuilt, but they're going to have a bunch of factories with absolutely no one to sell to because we are broke. America's broke, so we can't buy any more Chinese stuff, and there's not going to be anything in China to sell. There's not going to be anyone to buy. They can maybe sell domestically to their gold holders, and gold and silver holders, but most of the Chinese are also broke because they bought, instead of going to gold, they bought a bunch of real estate. So to say that if you think the Communist Party of China is somehow doing better than us, then we should not have a free society. Then communism works, right? If you think communism if you think China's beating us, then that means communism works, and maybe we enjoy our personal liberties better, but communism is now a better state. And
Well,
I
I didn't say that.
Yeah.
I'm just.
I know you didn't. There are Chinese.
I'm
Chinese
just reporting on the injection of funds. But
yeah, absolutely.
I think China though has a lot more gold than they tell us publicly. They've got a lot more than 2.3 thousand tons.
That's also not a good. That's not necessarily a good thing, because
Yeah.
gold has having lots of gold in a system. I'm not talking about a person, because people mistake what I'm trying to say. For a person, yes, you always want to go seek out as much gold as possible. When a system has a lot of gold revolving around it, you only get two things. You get more jewelry and you get higher prices. So if China reveals they have 30,000 tons of gold, like we think they might, then that means prices in China in gold terms are going to be sky high, and prices everywhere else are going to drop like a rock, because we will want to sell them stuff to get their gold. Now, what's that going to do to Chinese industry? It's going to collapse it. Chinese export-based industry, when prices are sky high in China. So they have all kinds of problems on their end too. It's not like they are not outsmarting us. They're not outsmarting the system. The system is stealing from everybody around the entire world. And we Americans are sitting in drowning in debt. And in China, they're slaving away for American debt that's not worth anything. So they're slaving away for nothing.
Both the US and China face mounting economic pressures, whether it's America's debt-driven push toward hard assets like gold and silver, or China's struggle to sustain growth amid a real estate bust and reliance on weakening US demand. Precious metals are increasingly seen as safe havens in this fragile global system, and their rising momentum underscores a deeper shift away from trust in paper assets. Could silver's potential designation as a strategic resource accelerate its price far beyond current projections? If China reveals its true gold reserves, would that stabilize its economy or trigger more volatility worldwide? Feel free to share your feedback in the comments below. If you found this helpful video, hit the thumbs up and subscribe to keep up with our latest updates. We appreciate you being a part of this journey.
Like, I personally have a price target on gold up near 15,000. Not tomorrow, not this year, but in the fullness of time over the course of this bull market. $15,000 price projection is simply an average of the previous two bull markets, the one in 1970 through 1980, and then you call it 1999, 2000 through 2011. If you average the returns in gold through those two bull markets, that gives you about a $15,000 target. We're susceptible to a sharp pullback, that is true, but we're also, I think the path of least resistance is higher, up towards 50. And this chart here, this long-term monthly log scale chart, is kind of my roadmap. Higher targets near 50 and even near 75 on this move. So, silver is respecting the technicals. Right here, there's this trim profits line. So for me personally, if and when we get up to there, which coincides with somewhere between 44 and 50.
The long-term outlook for precious metals suggests significant upside, with gold potentially reaching $15,000 over the course of this bull market based on the average gains of the previous two major cycles. While short-term pullbacks remain possible, the broader trend points higher, with silver showing strong technical support that could drive it toward the $44 to $50 range, and possibly even $75 if momentum continues. Steve Penny, a respected precious metals analyst, trader, and newsletter writer, explains that after gold first touched $3,500 in April, the forecast was for prices to move sideways with a slight upward bias for several months, allowing silver and mining stocks to catch up. That's largely what played out, with gold consolidating for about 6 months before breaking higher, while silver and miners began showing strong momentum. The key lesson here is strategy. Knowing when to buy is straightforward, but investors must also plan their exits. Bull markets are volatile, with sharp swings both ways, so deciding whether to hold through volatility, take profits, or actively trade is critical. Looking ahead, Steve Penny mentions that the dollar sits at an important support level after months of decline, which has boosted precious metals. However, an unexpected bounce in the dollar could trigger a sharp pullback in gold and silver, especially since gold is at its most overbought level on long-term charts since 1980. While the long-term outlook remains extremely bullish, with targets of $15,000 gold and $200 plus silver, caution is advised in the short term. The strategy suggested is to trim speculative mining stock positions as silver approaches $50, then keep cash ready to buy back on pullbacks. To ensure you never miss an update, don't forget to subscribe and hit the bell icon as we begin the video. We appreciate your feedback, so please leave a comment below and give us a thumbs up if you found the article interesting.
After the April peak, where we first tapped $3,500 in gold, my forecast, I believe we talked about this. I know it's been a little bit since we spoke, but I was saying, hey, I think it's very likely that we just kind of grind sideways in gold for a few months to maybe a quarter or two. And, that's not what people want to hear when it's just ripping straight up and stocks are going down. We want to hear to the move. Well, that was back in April. Well, April, May, June, July, August, now we're into September. So 6 months almost of just kind of sideways. And now we're finally breaking out. But my forecast was that gold would just kind of trend sideways to maybe with an upward bias. And that would allow silver and the mining stocks to play rapid catch-up. And we're beginning to see that. That's finally coming to fruition. Now, as I share a couple of charts here, I just want a key takeaway from this interview is for people to think about your strategy. Knowing when to buy is fairly easy. It's when everyone hates it. But, everyone needs to have a personalized exit strategy of, are you going to just sit through the wild volatility? Are you going to take profits? Are you going to trade around your mining stocks? These are important things to think about, especially as things begin to move, because these bull markets are incredibly volatile. And we're seeing the volatility to the upside now. And as surely as night follows day, there will be volatility to the downside as well. So the question is, do you want to sit through that? And here's kind of a basic roadmap I have. Now, I think any roadmap should be taken with a grain of salt because no one knows the future, right? But one thing charts help us to do is, make if-then statements and have a roadmap. And then we adapt as new information comes in. And when I look here at this long-term chart for the US dollar, what I see since 2008 is a gently rising uptrend. And where are we at right now? We're right at the lower rail of that uptrend channel range. And of course, the dollar has been declining for several months now, for a while, and that's been a tailwind to hard assets, namely precious metals, silver and gold. Well, I think what a lot of people maybe aren't expecting is for a pop in the dollar, an unexpected pop in the dollar, and that could result in a sharp pullback in the precious metals. I mean, we've come really far, really fast. Gold on the monthly chart is now the most overbought it's been on the RSI since 1980. It's the second highest overbought condition ever. That doesn't mean it can't go higher. And I'm not saying that. You're talking to someone who's probably as bullish as you can possibly be. I just told you I think gold's going to 15,000. I think that's fairly conservative. Silver, $200-$300 or more. But at the same time, over the short term here, I think caution is warranted. So I'm certainly wouldn't be chasing, gold and silver here. But you can see on this dollar chart, we followed the roadmap so far. I drew this potential path a while ago, and we've declined. Well, now here we're sitting right at the lower rail of the support. I could see some kind of exogenous shock causing a pop in the dollar. That just intuitive reactionary flight to safety, perceived safety, because you and I both know, the dollar should not, be a safe haven, but that's the knee-jerk reaction when panics happen. So I think that could happen. That could see a pullback in precious metals, and how you want to trade around that is obviously for you to decide. But for me personally, I plan to take a little bit off the table in my speculative mining stock positions as we move up towards 50, if that does indeed happen, in silver, and then have cash available to scale back in on any kind of pullback.
Steve Penny, in an interview with Liberty and Finance, points out that in silver bull markets, most of the gains often come in a short burst near the end of the cycle. While silver could face pullbacks, the technical setup suggests prices are headed toward the $44. That may be a good point for traders to take some profits in paper positions like mining stocks, while physical silver remains a long-term insurance policy. For gold, prices are already in a zone where trimming speculative exposure could make sense, as miners like GDX show extreme overbought signals despite gold being far higher than in past cycles. At the macro level, Steve Penny thinks that the Fed is under immense pressure, as soaring debt makes interest payments unsustainable. Historically, governments always choose to debase their currency rather than default, and the US is no exception. With markets expecting a rate cut soon, the real test will be the long end of the yield curve. If long-term rates rise even as the Fed cuts, it would show a loss of control, likely forcing extreme measures such as yield curve control. That scenario would accelerate the bull market in precious metals, fueling even stronger gains ahead. Let's get the interview started now.
90% of the move in silver bull markets happens in the last 10% of the time. And, that may not be exactly numerically correct, but conceptually, I believe it is, where you get the biggest moves in the last part, of a bull market. I'm not saying the bull market is over, but my point is, right now, we're susceptible to a sharp pullback. That is true, but we're also, I think, the path of least resistance is higher, up towards 50. And this chart here, this long-term monthly log scale chart, is kind of my roadmap for, hitting higher targets near 50 and even near 75 on this move. So, silver is respecting the technicals. Right here, there's this trim profits line. So for me personally, if and when we get up to there, which coincides with somewhere between 44 and 50. So the short answer is I think we're probably headed somewhere between 44 and 50, maybe a little bit higher. But I think that could present an opportunity to take just a little bit off the table in speculative positions. Now, I just want to give a caveat. When I say that, I'm talking about paper positions. I'm not talking about going to sell your physical. To me, I view physical as a generational insurance policy against these out-of-control central planners. I don't trade that. I'm talking about if you're into mining stocks, if you're into paper trading vehicles, that could be a time to take a little bit off the table between 44 and 50 in silver. That's kind of what I'm looking to do myself.
And as for gold here, do you have any price targets of where maybe taking at least some paper profits off the table would be a good option?
Yeah, so I think in gold, we're probably already in that territory. So one of the cool things probably isn't the best way to put it, but one thing about when you're in new all-time high territory, a lot of people think that's bearish. Oh, you're overbought and it's all-time highs. Well, that's actually can be bullish as there's now no overhead resistance. But you can use kind of like price projections and measured move targets. And my measured move target for this year was about 3,500. So we've already exceeded that. So I think this could be right around in here between 3,500 and 4,000. If you're in big gold miners, like you can look at a chart of GDX and that would probably be a good one to pull up. But like on the chart for GDX, we're getting extreme overbought and we're closing in within, spitting distance of the all-time high resistance at GDX. Now you can make a case, last time GDX was at this level, gold was $1,900 back in 2011. And here we are, $3,600 gold, and GDX is just getting back to that same level. So you can make a case that it slices right through it like a hot knife through butter. However, just from a purely technical perspective, we're getting overbought here, right now, in the big gold miners. And before I moved on, I did want to just share this chart for GDX. This is that long-term monthly chart. And you can see, look at this RSI right here on the top right of the screen. I'm hovering over it for anyone watching on YouTube. The monthly RSI is at 80. That's the highest ever on record. Not like an immediate sell signal, but it's a caution signal. Kind of be aware of that. And as a general rule, when you get extreme overbought against clear, obvious resistance, typically you don't punch straight through it. So big gold miners, that just reinforces the case to maybe take a little bit off the table before, I think we're ultimately going much higher. So it's up to, individuals if they want to just sit through that volatility or, kind of use volatility to your advantage. I look at like the drama going on between the Fed and the president as kind of theatrics and a sideshow. It just highlights what you and I have known for a very long time, and that's Tina. There is no alternative. The Fed is between a rock and a hard place where they have to choose between sacrificing the dollar or sacrificing the economy. And history is replete with examples where central planners, those in power, always choose to debase the currency as opposed to default honestly. The federal government's in a situation, by the way, this is all governments around the world, every single one, 100% of them, are in a situation where the debt is mathematically unrepayable. So they can choose to either debase the currency or, default, honestly, and they never choose to default. So they're going to debase the currency, and that is just explanation for why there's such pressure on the Fed to lower interest rates and, make more easy money to try and kick the can down the road. Because the biggest variable, we're heading to a point, and this is something I think everyone should understand, we're heading to a point where 100% of our tax dollars, 100% go to just service interest on the debt. That's the trajectory we're on. And the biggest variable in that equation of how to kick the can down the road is lowering interest rates. So, no one wants this, currency crisis to happen on their watch. So how do you kick the can? Lower interest rates. And that explains why there's such pressure on the Fed. And I will throw something out there. The futures markets are pricing in like a 90% probability that the Fed will cut rates on September 17th, just a couple weeks from now. The thing to watch is, and I'm not predicting this, but it's something to watch, is the long end of the curve. Watch the 10-year and the 30-year and see if, as the Fed cuts rates, if rates actually go up. That would be an early warning sign that perhaps the Fed is losing control. If they're cutting rates and then the long end of the curve, interest rates rise, that would indicate they're losing control, and that would indicate that they're going to need to apply even more dramatic measures like yield curve control, which when that happens is just going to be like pouring gasoline on the bull market in precious metals.
Gold and silver remain in powerful long-term bull markets, with potential for historic gains driven by currency debasement, debt pressures, and shifting global demand. While short-term volatility and pullbacks are inevitable, the broader outlook strongly favors higher prices, making precious metals both a strategic investment and a form of financial insurance. Do you think the Fed will be forced into yield curve control sooner rather than later? At what price level would you personally consider taking profits on silver or gold? We'd love to hear your opinions, so please leave them in the space provided below. If this video was useful to you, please give it a thumbs up and remember to subscribe for more. Thank you for being a part of our journey.